Welcome back. You're watching India market close at the 25,948 levels right now on the Nifty. Market breadth still not really positive and narrowing as we speak, but stock-specific stories are still ruling the roost. The other big theme today, of course, has been what the SEBI has proposed. They finally put out a proposal which was long awaited on what are the measures that could be taken to curb speculative activities in futures and options. So there are about 7 measures. There you have them on your screen. Now the question is, what is the kind of impact it would have on the market? And we've got Nandik Malik, or CIO of Avendus Capital Alternate Strategies, to come in and speak with us. Nandik, great to have you back on the show. And on, I would say, an interesting subject which the market has been waiting for, I think with bated breath, to see what happens. Do you think that this is slightly better than what was anticipated?
No, I think the markets had factored in that some kind of measures will be taken by SEBI because the volumes are really scary. So if you look at the volumes, daily volume in the F&O segment was somewhere around $2 trillion. Somewhere around 400, 500 times the stock market volume which you have in stocks. So I think what SEBI has done is very rational. And the increase in margins, the decrease in the number of strikes that you have, I think are welcome moves. See, what this will do is some volume will go away, but the main volume which will decrease is the volume which happens on expiry day. So SEBI in its circular has done a detailed research, and they are quoting facts and numbers. So what they are saying is a huge amount of volume happens in expiry days when people come and try and sell, let's say, options for 3 or 4 rupees. When, let's say, Nifty is at somewhere around 24,000, 25,000, and then they try and make some money out of it. So now this kind of a strategy doesn't really help people who want liquidity in the markets for hedging positions or, diversifying some of the risk away. So even if this volume goes away, there's ample volume in the system to meet liquidity management and, let's say, portfolio management needs. So I don't think this move will kind of put any restriction on fund managers or funds who want to actively hedge the portfolio. So all in all, I think it's a good move by SEBI.
How much do you see volumes being impacted, Nandik?
So volumes will go down for sure. So I'm not sure that margin increase. So they are saying the margin will be doubled first and then tripled over time. I don't think this will have a meaningful impact on the volumes. What I think will have a significant impact is there is one particular point in which they say, at least that's what my interpretation is that one particular exchange can have only one weekly option. So, for example, right now we have the main exchange in which on each and every day we have weekly expiry. So what I could decipher from reading the SEBI note is that now one exchange will be allowed to have only one index derivative which expires in a week. Because of which what will happen is, let's say 3 or 4 daily expiries will go away. So that is where the volume drop will happen. But that is unlikely to happen in the main indices vis-a-vis, let's say, Nifty or Bank Nifty. So there will be some volume, but that will be primarily on account of volume drying up in the other indices. Now, good amount of that volume should also transfer to the main indices. So what should happen going forward is the volume in the main indices should go up. And because weekly index options in many of the other indices will not be available in the first place, they will become zero.
Okay, so you will see a transfer there. A lot of conversation about, and some are calling these as de-addiction measures by SEBI. A lot of conversation of what those who are, quote unquote, again, addicted to this kind of speculation, what they will do, where will that money go? Could it go into penny stocks? Could it go into commodities, derivatives trading? Does the grey market get a boost? Just wanted to know if you have thoughts on any of these.
No, so these options are available because you're right, that allocation can shift. But what is interesting to me is when someone, takes position, let's say as of now, or let's say a month back, or let's say for the last 1 year has been taking position in index derivatives. Typically, they would not be playing for 1 lot or 2 lots or 3 lots, right? The positions would be 4 or 5 lots. So if the lot size doubles, then previously they were taking, let's say, 2 lots. Now they have to take 1 lot. So I don't think that will, meaningfully impact that kind of a psyche. What will happen is sometimes people used to take those 3 or 4 rupees bets. So let's say Nifty is at 24,900 to 25,000. On the day of expiry, let's say at 310 or 315, and SEBI has mentioned this point in the paper also. If they see, let's say, 3 rupees premium for an option which they think would become zero over the next 20 minutes, then some positions would be taken and huge amount of positions would get taken. So that gets taken out. I am not very sure that money would get diverted towards penny stocks or let's say other kind of instruments because the options market works on the concept of margin money. So which means that if you want to take position worth 10 lakhs, the actual money which you have to give is say only around 2 lakhs or 1.5 lakhs as the case may be. Now, if you want to take position equivalent of let's say 10 lakhs in penny stocks, then you have to actually give the entire amount upfront. So, because of that, I think the kind of concerns which have of this money moving into other asset classes may not be as drastic. Some amount of movement can happen, but not as drastic.
What about movement in commodities trading, commodities derivatives trading?
Yes, some amount of money can move there. But regulations can come in that market as well.
Yeah,
So
because the underlying concerns are the same.
correct,
If
correct,
if
correct.
there is, a lot of conversation now, Nandik, on whether these proposals is what we will eventually see, whether there will be tweaks here and there. What do you think? What do you think? Because I'm not sure where there's any opposition coming in from. Even exchanges will have to toe the line.
No, exchanges will have to toe the line. And today, for example, one exchange is up a lot because people are anticipating that the volume on that particular exchange will go up. So see, it's a regulatory thing. Exchanges, I don't think have any say on this particular topic. I think it's a good proposal. It's a working paper at this stage, but I don't see where any objection can come from any market participant, from any credible market participant. So to me, it's black and white, and this is as good as go.
We just played a few minutes ago what Nitin Kamath tweeted on this, and among other things, he says that maybe having a product suitability framework is the answer, where you judge and you assess which product is suitable for which kind of an investor. Is that something that you agree with?
Yes, and that is something which SEBI has done in the last week. So they have circulated a paper saying that something called a new asset class may be allowed going forward. It's again a working paper, and they have asked feedback from market participants, but that is something which SEBI has already done. So I think everything seems to be very coordinated, and it's a very good thing to see that the regulators is keenly watching as to how things are shaping up in this field.
Good thing, Nandik. Just want to put the other point of view in front of you, and what do you think? A lot of commentary today and a lot of concern that is it the regulator's job to tell retail investors what to do and what not to do, and assume that they can't use their own mind.
See, I did my BTech in electrical engineering, and so in our labs, the professors were very strict when we used to go to machines, and we would think that doesn't make sense because we all are in the top college in the country, we know what to do. But then come to think of it, if something bad happens, then no one will go to the investors. Everyone will come and ask SEBI as to what checks and balances did you have in place. So I think. SEBI is the decider as to what the rules would be. As market participants, we cannot challenge those rules. We have to adjust ourselves to the existing conditions and then take positions accordingly.
Okay, that's interesting. So SEBI has reminded Nandik Malik about his lab professors, where he realized in hindsight that what they were doing and when they were strict was for his own good. Thank you so much, Nandik. Always a pleasure chatting with you.